Hello, welcome back. Today we're going to have a very honest conversation about a trend in the last few years. If you have a mortgage, you've seen the ads. Switch to us and get $2,000. Refinance today and receive $4,000 cash back. It sounds incredible, doesn't it? It feels like free money. It feels like you're finally sticking it to the banks and getting a win for the little guy. I see all the time. I see borrowers who treat their mortgage like a prepaid phone plan, switching every 6 months to chase that sugar rush of a cash bonus. They're serial refinancers. They're what the industry calls churners. But today, I want to ask you a very serious question. Are you actually winning? When you peel back the layers, when you look at the hidden costs, the damage to your reputation, and the strategic chaos this creates, are you really pulling one over on the bank? Or are you actually tripping over pennies to save dollars? In this episode, we are going to deconstruct the frequent refinance strategy. We're going to look at the math, the psychology, and the hidden consequences that nobody tells you about in those glossy brochures. So, let's dive into the truth about rate hopping. Segment 1, the mathematics of free money. Let's start with the money, because that's the hook, right? You see a $4,000 cashback offer. Your brain lights up. You think, that's a holiday. That's a new sofa. But let's look at the friction costs. The source material for today's discussion highlights a crucial point: the erosion of that benefit through fees. Now, you might say, but wait, Australia banned early exit fees on variable loans years ago. And you'd be right. The big, scary exit penalties are mostly gone. But banks are smart. They didn't just stop charging, they just renamed the costs. When you leave a bank, there's almost always a discharge fee. It sounds administrative, but it could be a few $100s. Then, when you land at the new bank, there are registration fees to register the new mortgage on the title. There are settlement fees. And let's not forget the government fees. Every time you swap a mortgage, the title deed has to be updated. The government charges for that. Then there are the third-party costs. You might need a conveyancer or a solicitor to handle the settlement. You might have to pay a valuation fee if the new bank wants to check the price of your property. Suddenly, that $4,000 cashback isn't $4,000. Let's do the math. Discharge fee, $350. Registration fee, $150. Settlement fee, $200. PEXA electronic settlement fee, $100. Maybe a rigid application fee at the new lender, $600. You could easily be looking at $1,500 to $2,000 in friction costs. Suddenly, your $4,000 profit is cut in half. And we haven't even talked about the biggest cost of all, which is your time, but we'll get to that later. The point here is, do not look at the headline number. The bank offers the cashback because they know they will make it back from you in interest or fees eventually. If you leave too soon, you might find that after paying all the middlemen, you've done a lot of work for very little actual gain. Segment 2, the invisible price tag, your credit score. Now, let's move to something less tangible, but arguably more dangerous, your credit report. In the file we're discussing today, there's a strong warning about the impact on your credit history. This is something many Australians misunderstand because our system has changed recently to comprehensive credit reporting. Here is the reality. Every single time you apply for a refinance, the new lender performs a hard inquiry or a credit check in your file. If you refinance once every 5 years, that's fine. That's normal behavior. But if you are refinancing every 6 to 8 months to chase bonuses, your credit file starts to look like a crime scene. Why does this matter? Because credit scores are built on stability. Frequent inquiries signal distress. To an algorithm or a credit assessor, a person who applies for credit 4 times in 2 years looks risky. It looks like someone who is desperate for money, or someone who is structurally unstable. The consequence: the source material points out a chilling reality. This damage can block you when it really matters. Imagine this scenario. You've spent 2 years churning loans to make a few $1,000s in rebates. Your credit score has dipped from excellent to average or below average due to the volume of inquiries. Suddenly, a dream investment opportunity comes up, or maybe you want to upgrade your family home. You go to apply for a large, complex loan. The bank looks at your file. They see the instability. They see the inquiries. And they say no, or they say yes, but at a much higher interest rate, because you are now a high-risk borrower. You have sacrificed your long-term borrowability for a short-term cash injection. Is it a trade you're willing to make? Segment 3. The human element, burning bridges. This next point is one of my favorites because it's almost never discussed in public. It's about the relationship you have with your banking professionals, your mortgage broker, or your personal banker. The text we're analyzing mentions that experienced brokers and bankers may actually stop wanting to work with you if you refinance too often. Let me pull back the curtain on how the mortgage industry works in Australia. This is inside baseball. When a mortgage broker writes a loan for you, the bank pays them a commission. However, if you, the client, leave that bank within the first 18 to 24 months, the bank takes that commission back. It's called a clawback. If you're a serial refinancer, you're literally costing your broker money. You're doing work that results in them getting paid $0 for hours of effort. Now, you might say, I don't care about the broker's profit. Fair enough. It's a ruthless market. But here is the danger. Good brokers are gatekeepers. They're the ones who can structure complex deals. They're the ones who can fight for you when your application is borderline. They're the ones who know which lender will accept your self-employed income or your unusual bonus structure. If you develop a reputation as a churner, the best brokers, the ones with the deep experience, will fire you as a client. They will prioritize the stable clients who value the relationship. So, fast forward 3 years. You're in a sticky financial situation. You need a creative solution. You call up that top-tier broker, and they're too busy to help you. You have burned your bridge to expert advice. As the source text says, when you really need help in the future, finding an experienced hand to assist you might become incredibly difficult. Segment 4. The life admin nightmare. Let's step away from finance for a second and talk about quality of life. We live in a busy world. We are all-time poor. The text emphasizes the sheer exhaustion involved in this process. Refinancing is not just clicking a button. It is a massive administrative burden. Think about the paperwork, digging up payslips, updating statements of debt, verifying ID, waiting on hold with call centers, negotiating with a new lender. And that's just getting the loan approved. What happens after settlement? You have to set up a new banking ecosystem, new BSB and account numbers. You have to move all your direct debits, electricity, gym, Netflix, school fees, insurance. You have to learn a new banking app interface. You have to remember new passwords. If the new bank's customer service is worse than the old one, which happens often, you'll feel that pain every single day. You might have saved 0.05% on your rate, but now you spend 20 minutes on hold every time you need to fix a transaction. The source text rightly points out, is the juice worth the squeeze? When you have a career, a family, and other investments, do you really want to spend your precious free time filling out Form 14B for the third time this year? Frequent refinancing is a recipe for decision fatigue and burnout. Segment 5. Strategic uncertainty versus the blade. Finally, I want to talk about strategy. The most profound point in our source material is this. Refinancing disturbs your long-term financial planning. Every time you move a loan, you are resetting the clock. You are disrupting the structure. If you're an investor, you might have cross-collateralized loans or specific tax structures. Moving these constantly creates a chaotic environment where you lose track of your baselines. The text uses a beautiful phrase. Refinancing should be used on the blade. What does that mean? It means refinancing is a tool, a sharp instrument that should be used for a specific, high-value purpose, not just because you're bored or want a bonus. So, when should you refinance? You shouldn't just do it for a rate drop or a cashback. You should do it when it unlocks a new level of your financial journey. Reason 1. You need to release equity to buy another property. Reason 2. You need to consolidate bad debt, like credit cards, into your mortgage. Reason 3. Your income structure has changed, for example. You became self-employed, and you need a lender who understands that. Reason 4. You are renovating and need a construction loan facility. This is what the text refers to as satisfying multiple financing requirements. If you are refinancing, you should be asking, does this move me closer to my 10-year goal? Not just, does this give me $2,000 today? If you have a complex portfolio, Maybe multiple investment properties, a company structure, varying income streams. Changing lenders is a pull one thread and the whole sweater unravels situation. You need stability to plan. You need to know that your funding is secure so you can focus on growth, not just administration. Conclusion. The verdict. So let's wrap this up. I'm not saying you should be loyal to your bank. Banks are businesses, not your friends. If your rate is terrible and they won't negotiate, by all means leave. But the frequent flyer approach to mortgages, the strategy of jumping ship every 6 months just to harvest cashback offers, it is a trap. It's a trap that costs you in hidden fees that eat up your profits, damages your credit score, making you look risky to future lenders, destroys your relationships with the brokers you will need when things get tough. Waste your time and mental energy on low-value admin tasks. Destabilizes your long-term strategy for short-term gain. As the text concludes, you must distinguish between small favors, like a tiny rate drop, and future investment returns. Don't serve the bank's marketing department. Serve your own long-term wealth. Use refinancing as a strategic weapon, not a hobby. Make sure that when you do move, it's for a reason that changes your life, not just your weekend spending money. That's it for this week's episode of The Wealth Architect. I hope this gives you some pause next time you see that flashy cashback ad. Think about the big picture. If you enjoyed this video, please leave a review, and I'll catch you in the next one.